I am Fred Sturm, and it's my pleasure to be here to warm up the house for Bill Campbell, who has a lot of hard-earned wisdom in the subject at hand. I'm going to love hearing what he has to say. But what I'd like to do in the next few minutes is to just say what swap spreads are, how they look, how they act, tell you why you should be interested, why should you care, and finally to say a few things about how you structure a swap spread trade. So, I'm going to wager most of you know this, but there's always a guy in the audience who doesn't, so I have to do this. So a swap spread is nothing but a bank credit spread. It is the spread between a LIBOR reference term yield and a treasury yield with the same term feature. The bank credit leg of the spread can be built out of all sorts of different stones. If you're a swap dealer or a swap trader, you might use over-the-counter swaps. These days, a plain vanilla LIBOR reference swap has to be traded on a swap execution facility. I think some of them are more comfortable with this than others, but that's the regulatory reality. You have a whole bunch of things at CME's designated contract markets that are available to you. Eurodollar Futures, I think, are the acts of choice, not just individual contracts, but combinations of them. If you're adventuresome, you can also use CBOT swap futures for physical delivery. The treasury leg of the spread is a lot easier. Either chocolate or vanilla. You can use a cash treasury note, or you can use the CBOT treasury future. In one case, you're using a spot starting yield, the yield for T+1 value. In the other case, with the future, you're using a forward starting yield as of the future's delivery day. And what you're going to do is take the forward starting yield for whatever note is cheapest to deliver into that treasury future and plug that in. There's a whole lot of approximation and Hail Mary that you have to sort of invoke when you do that, but there's a whole huge cottage industry of invoice swaps that do essentially what I just described. This is what it looks like. So what can I say? Swap spreads go up and down, far and wide. They are pro-cyclical. That's 27 years worth of daily history. It looks like sort of a badly mowed backyard in West Virginia. And I could describe why these things go up and down, but in the interest of time, they tend to go down lately. Now, you might conclude looking at this plot that this is a big highway to nowhere, and I wouldn't want you to draw that conclusion because you want to look at what the volatility is, and that's a slightly different story. The volatility picture here, these are moving one-year H-vols. If you pick your spots right, there's actually stuff to chew on. At the 2-year term to maturity, we are at, what can I say, 27-year lows. And that's because the 2-year term to maturity is close enough to the foot of the yield curve to be hostage to the stasis of monetary policy. If you move out to 5 years, however, it's a different story. Starting about a year ago, volatility has been on the upswing. It comes and it goes, but for some months now, it's been back within the range of levels that you would have seen in the mid to late 1990s. And old-timers will recall that that's when the swap spread kind of grew into adulthood. That's when this became a trade that people want to do a lot. So, at least at the 5-year term to maturity, there's stuff already that you can put to work for yourself. So there's volatility that makes this worth why would you focus on this trade and not 17 others? There are a lot of reasons. It's very democratic. You don't have to be a swap dealer at a large bank. You do not have to be a swap user at a large institutional money management firm. You can be anybody. Especially if you do this in the futures-to-futures context. You can do this without touching an over-the-counter interest rate swap at all. It's a big tent. It welcomes all sorts of different trading styles. Your time horizon might be very strategic. You might be the sort of person who puts a position on for a month at a time. That's fine. There are things you can do. You might be somebody who wants to trade by the nanosecond. That's fine. There's stuff you can do here. It really does have something for just about any horizon. It also rewards craftsmanship. There's a lot of detail in a trade like this. About a year ago, I came here and bored the tears out of a whole crowd of you discussing the details of constructing these things. I guess people have trouble getting to sleep because the peak ball is right, and there are a lot of people looking at this download, and maybe it helps them get to sleep. But if you want to see just how much detail is involved, I'd ask you to go back to a presentation from a year ago. So that's work. But this is the sort of trade that will reward detail. How you manage the treasury leg. If you want to put together the Eurodollar side of it, or the bank credit side of it so that it replicates a Eurobond, there's a lot of work involved. You get those details right, this is actually something that will pay you. Creativity. As we'll see in a minute, there are various ways in which you can put together the bank credit leg, and there are a lot of artful ways in which you can approximate that LIBOR exposure, and the creativity with which you do that will be rewarded. Finally, it's going to be around for a while. Government securities market isn't going away. Not here, not now. I think a lot of us were afraid for a while, going back maybe 3 years, that, is LIBOR going to survive or not? And I think we have Martin Wheatley, now of the UK Financial Conduct Authority, to thank for having circled the wagons around LIBOR. Instead of trashing it, he said, okay, too many people rely on this, we need to make it bigger and stronger. So LIBOR, may be determined in different ways a decade from now than it is today, but LIBOR is going to be around. So, if you become a student of this spread, the lessons you teach yourself today are probably lessons you'll be using in one way or another 10 years from now. And that's the kind of topic I like to study. I also get stupid showing this slide to you guys. I actually know this, but this is just nomenclatural. If I buy the swap spread, I am buying treasury exposure and I'm selling either Eurodollar futures exposure or selling deliverable swap futures exposure, or I'm the fixed rate payor in a plain vanilla interest rate swap. The obverse applies if I'm going to sell the swap spread. A couple of notes here, especially if you do this in the futures, pure futures context. For much of the rest of my remarks here, I'm just going to pretend that few, if any of you, have any interest in touching an over-the-counter interest rate swaps. I'm just going to pretend, no offense intended to anybody, I'm just going to pretend that you want to do this in a futures-to-futures context. And if you do, this swap spread exposure is going to be forward starting. And depending on the leg that you're focusing on, Bill Campbell is going to have a lot to say about this. This is an interesting topic. If the treasury leg is kind of the pivot of your trade, if that's your focus of interest, then the forward start date is going to be the likeliest delivery date for that treasury future. If instead the the bank credit leg, the Eurodollar Futures leg is the focus for you. Then the forward start date is more likely to be the third Wednesday of the expiring month, IMM Wednesday. One other word of warning. If you use Treasury futures, you really don't want to be monkeying around with futures that are in their delivery month. If you're going to use a Treasury future, use one that is trading prior to its first position day. Eurodollar future, let's assume you're using Eurodollar futures. It can be just about whatever you want. The iron law. Interest rate exposure, interest rate responsiveness on both legs of the trade has to be the same. DV01s have to be equal. If you get that right, everything else falls into place. There are two ways, I'm making a big broad generalization, but there are essentially two ways in which you can put together the bank credit leg of the trade. One is analytical, the other is empirical. The analytical approach was quite popular in the 1990s. It's not so much in favor now because it's a lot of work. And what you do, I'm not going to belabor the details because it really isn't important. If somebody asks, I'll tell you, but you'll regret it. Essentially what you do is you take the interest rates that are implied by 10 years worth of Eurodollar futures, you use those contract rates to daisy chain out a discount function. You can then use that discount function. It's a LIBOR basis discount function. You can use that to pull to present value any future cash flow you want. And that would include the future coupon payments and principal payments for a treasury note. So you can use this LIBOR reference discount function that you pulled out of the term structure of Eurodollar futures rates and treat the treasury note as if it were a Eurobond. With a little bit of work, you can also get the dollar value of an 01. You can jitter each of these Eurodollar futures contract rates by a bit. You can see how the present value of this treasury note changes, and bingo, you got your PV01. What's nice about this approach is it's unique in the sense that you get a future structure that implies a yield to maturity that bumps up very cleanly against the treasury yield. What you've done is to use a bunch of futures to create a synthetic Eurobond. And you can actually talk about yield spreads in ways that make sense. The disadvantage is that it's rigid, it's kind of unforgiving. You'll see in a moment, I'll show you. You end up with a Eurodollar futures combination that looks very peculiar. It probably doesn't trade comfortably except by a block trade. Just trying to maneuver in and out of it may be cumbersome. You may suffer slippage. So it has to be handled with a lot of care. And that may be the only reason for why this thing has fallen off in popularity. The other way to do this can actually be a slob, and as long as you're creative about being a slob, you can still trade this. Empirical swap spreads. To make sense of this, you have to be willing to look at correlative relationships between lots and lots of Eurodollar futures and Treasury futures. You have to be a very close student of the empirical properties of the price dynamics in these things. Once you've got that, you can just sort of choose which Eurodollar future or combination of Eurodollar futures suits your taste. You might want something that is loosely correlated with the Treasury future. You don't want them marching in lockstep because you're not going to earn or lose very much on the trade. So you might want a loose correlation just because your winnings might be larger. If you are on a really tight risk budget, or if your risk discipline is such that you want to keep these things on a short leash, then you might want some Eurodollar stack or bundle or something that stays pretty close to the price dynamics of the Treasury future. What's nice about this? It's very tractable. It's easy to trade. It's no more than getting in or out of a Eurodollar stack or a Eurodollar pack or a bundle. What's disadvantageous about it? You don't really have a yield, a synthetic yield, that spreads off in any sensible way against the Treasury note yield. There is a Eurodollar futures forward rate, but it's going to be some, average rate for 3 years out if you're using a green pack. It's not going to be a yield to maturity in any way that I would recognize, or that you would recognize. Doesn't mean you can't trade it, but you just have to sort of work around it. First time I made one of these pictures, I was working for Joe and Tommy Guy. And Bill Harrington was there. And he's here now. There are lots and lots of ways you can study. Take yourself to school on these correlative relationships. This scratches the surface. One thing you can do is just take various data samples and study how Eurodollar futures price dynamics correlate with the Treasury future at hand. In this case, I'm using the front 5-year note. And I'm bumping it up against the thick blue line is one each correlation for each of the first 20 Eurodollar futures. I can bump it up against packs. I can look at the price dynamics for packs. Do the same thing for the bundle. I can look at it for short time periods. That's 3 months. 1 of May through end of July. I can scrutinize longer periods. This is secular. This is a decade. Doesn't hurt because this tells me how different, what's going on now might be versus what's been going on in the background for a long time. But here's the point. No matter which of these pictures you look at, you've got a menu that might help you find the correlation level that is your comfort zone. If you want a Eurodollar structure that pretty much marches in lockstep with the futures, the Treasury future, go for the 4-year bundle. You're down to a correlation level of about 90 there, okay? There are certain bank risk managers who would ask you to be fired for treating that as a hedge. But if you're speculating on the spread, that at least might give you some money. The point is, you know what your risk tolerance is. You're going to know how much maneuvering you want. You can set that risk tolerance as wide as you want. It's the same story. Latest 3 months, same interval a year ago. Bill Campbell and I were having a conversation a few days ago. He posed the question, what did this look like a year ago? This is the sort of exercise you might want to go through. How have things changed? How are they changing? How might they change in the future? As long as it helps you think about be a better trader. This, by way of coda, this is to give you some notion of the variety of structures that you can use just with Eurodollar futures alone. This is an old example, but I like it. It shows what I wanted to show. I was too lazy to go to the trouble of making up a new one because it wasn't going to show any differently. So here we are, August of a year ago, almost exactly a year ago. This is a two-year future against, eight Eurodollar futures. If I wanted to make a synthetic Euro bond to bump up against that SEP 23 two-year future, here's what it would look like. It's a strange-looking bunch of numbers, but those are there because they are a synthetic Eurobond equivalent to the cheapest to deliver for that SEP 2013 two-year note future. As I said earlier, this is great. You've got something with a lot of exactitude in it. It's not so great because you really do want to get in or get out of that thing just the way it is. Or you can do a lemon version of this. There's a very, very, very long story about why this is a lemon TED. I'm not going to go into it, but you can take all the work you've done here and collapse it into a couple of Eurodollar futures stacks, one that's on either side of the cusp between the white pack and the red pack. And if you believe that that gives you sort of a pivot point, well, okay, there's a lemon TED. People do this, people make money at this. There's 1% that actually makes money. You can do stacks. There's a pack. There's a two-year bundle. What do they all have in common? The DV01 of the SEP 2013 two-year note is approximately $37.81 or something per 01. So for 1,000 lot, it's about $37,800 bucks. That would be the DV01 for the treasury leg of this strategy. Do the math. In each case, the total number of Eurodollar futures is 1,512 or 1,513. Either way, you're within a whisper of $37,810. That's really all there is to it. That's the guiding principle. That's kind of the unifying principle behind all these things. Now, how you put these together, how you decide where you want to put down stakes, how you manage it, this is key. This is how you survive. This is how you get something to eat at the end of this day so that you live to trade another day. And this is where I yield the stage with pleasure, with delight and honor too.
Before we transfer, can I ask you a question about your correlational studies?
Of course.
I want to look at the chart and look at it compared to, I noticed that you had a nice little correlative curve. Is that curve against the empirical bundle?
Yes.
Okay,
Yes.
And I see a line there that says stack. Where's the stack on the curve?
The thick blue line is the same. So,
Okay.
And it's so funny. It's hilarious. Lately, the nearby Eurodollar future is just about uncorrelated. Within a whisper of 0 against the 5-year treasury future. And it's just how odd monetary policy is these days. So this is way down here. If I were wander out to the fourth white, I'm not even at 75 in terms of correlations. 0.75. You want to be a stickler about it. So that's down to the basement. But those are bundle marks. what I've done is back out Eurodollar futures equivalent, INM index equivalents. It's not the way bundles trade, but for this you want to make it look like a Eurodollar future. So that's just arithmetic. Here's the joystick.
All right. Okay, I'm Bill Campbell. I had a company, as Paul said, called ArpSoft. TT now owns all the technology from ArpSoft, and we've built a good chunk of that technology into the X-Trader at this point in time. More is coming, and we'll keep you advised of that. As Fred mentioned, analytical TED spreads. Most of you either know how to do the math, but really don't want to, or if you did the math in Excel, we all know how wonderfully Excel behaves when you don't want problems. In other words, it doesn't behave well. Or I get paid to trade, not to program, so you didn't want to do the Excel work in the first place. If you've been to one of Fred's seminars in the past, he went through all the math, said this is how you do it. Just simply go put it in your Excel program and voila, you have it. But you didn't want to. So we've taken a lot of that and moved it into the X-Trader for you. And like everybody says, just make it easy. I want to trade, you do the math, I'll do the trading. So we did make it easy. We collapsed all of that analytical TED, all that stair-stepped of hedge, into one ladder. So now what you can do is you can place orders, just like you're used to doing, in a single ladder, and the pieces will execute for you when the TED gets to those levels. This is for the analytical TED. So if you remember the slide that Fred had up that had hundreds of different quantities for all 8 Eurodollars, that's now collapsed all into one ladder. You can set up individual pre- and post-hedge rules for each one of those legs for the whole thing, so that it takes into account things like market size, whether you want to lean on a single contract or you need to have at least 1,000 there or whatever. All those types of rules can be built into the auto spreader. The setup for that, you come in here, you pick the futures yield for the futures, you turn the Eurodollars into 100 minus basically, that's what this does. And you put in the stair-step ratio up here, and you're done. 3 steps, and you're done. No real programming. As simple, if not more simple, than a baseline equation in Excel. And you've got it in. What's nice about it, when you get it right, it says valid formula. It's red and says invalid until that point. I'm not going to bore you with how to get all that in there. We'll talk about that later. But it's that simple. 3 steps, and you're done. If you want to move to the empirical TEDs, which are more fun, they're easier to execute. You don't have to worry about each one of those individual pieces. They generally, as Fred was saying, if you remember that correlation chart, create more volatility, so you have more things to trade. There's more places along the curve to trade. You can trade the lemon TED, an example of the 2-year, where you can trade, say, the 3-year versus the red pack, which is kind of like a lemon TED, but using the cash 3-year if you have access to the on-the-runs. You can trade, say, the 5-year versus the greens, if you remember the correlation thing that was way up at the top. Or you can trade 5-year versus the 4-year bundle. And if you want to get really creative, you can trade the 5-year versus the 4-year bundle plus the first gold. You can do that all in the X-Trader environment. The bad part, trying to get those change on day quotes for packs and bundles into something that looks like the Eurodollar yield index. I'm going to step into the academic world a little bit here. It's not a true yield on the Eurodollar side. We're not doing all the compounding and everything in the auto trader. We are using the yield index, the 100 minus. So we're doing that for the average or the weighted average of your strip. Tiny differences, but when you're trading these things, you're trading discrete amounts anyhow. And you just want to make it easy. You guys trade, we'll try to make it easy. So the empirical, and this is the limited, can get reduced again to just one MD trader. You could, if you wanted to, display the legs along with this so you can see where your orders are working in the legs. Once you get used to that, you probably don't. You just show one ladder. Place an order just like you're used to. So you have one ladder for your empirical, in this case the limited. Set it up here at the top. Label it nice. If you want to have another ladder that might be just the first red, label it differently. That will trade differently. This red will look a little different. You could have first red, last white, limited, all trading in ladders at the same time, so you can pick and choose which one you want to trade today. You're not locked in. The setup for that, again, using the futures yield against that same type of thing. Have it set up here. And you can see that you can adjust your weightings up here. If you want to do exactly 400 of each, go ahead. If you want to do 350 of each, go ahead. If you remember Fred's example, there were more the fourth white and a few fewer, not too many fewer, of that first red. We can do that. And that reduces to just that single column that you saw. This is the 3-year versus the red pack. Again, the quote looks very similar. What we've done is taken the yield of the cash 3-year, thrown the red pack into it, 100 minus that average price for the red pack. You're trading the 3-year against the red pack, trading two pieces, and you're getting this number. You could do, as I mentioned, the 5-year futures versus the 4-year bundle. You have to step in the ADL world a little bit to get that done because of the limitations on the number of legs. But once you get this done, it reduces to one ADL interface. You just take the 20 legs here, compare it to the 4-year bundle, come up with an index yield, use the futures yield up here for the cash. Again, you're trading two pieces. 5-year futures, I'm sorry, I said cash, the 5-year futures. Trading the 5-year future against the 4-year bundle, and you're trading it in a single number. And it's doing both pieces for you. You can control your hedge ratios. You can control whether you want to trade it dirty or straight. It's in one piece. Some of the things that I'm going to borrow from one of your slides, direct quote. Spread exposure is forward starting. Notional forward settlement date is either expected delivery date or IMM date. That introduces a level of uncertainty that some people aren't really comfortable with. Do I want to trade it for September 16th? Do I want to trade it for October 3rd? Do I want to trade it for today? So if I'm trading the 2-year cash or the 5-year cash or the 3-year cash against Eurodollar strips today, why can't I look at 2-year futures or 5-year futures or 10-year futures for today? So, it's kind of hard to think about a deferred trade versus a spot trade. Well, now you don't have to. Again, in the X-Trader environment, this is a detailed window. Typed in the coupon, maturity of the cheapest to deliver, picked the rolling settlement date, and typed in what I think is the IRP, and I can explain that term later, but it's basically a short-term rate. Most of you already know it. I typed in the IRP. What's going to go on behind the scenes is that the X-Trader is going to calculate real time for every tick in the futures the gross basis, add that to the gross basis, add that to the converted futures price, and come up with a spot price for today of the cheapest to deliver. From that spot price for today of the cheapest to deliver, you can then get a yield for today. So you get a spot yield versus the spot starting Eurodollar strip. So now you can compare that TED to the cash 2-year TED, to the cash 5-year TED, to the cash 7-year TED, 3-year, whatever you want to trade it against. Now you have all the same, not the exact same apples, but you have Jonathan's and Yellow Delicious, Red Delicious, all the way down the road. You're not looking at forwards and spots. You can look at the whole curve for today. So we've taken that problem away. And again, that's built directly into the X-Trader. But if you want to take a look at it, say against the September 15th date for DSFs or IMF swaps, you want to look at it forward, that flexibility remains. You switch the settlement date from rolling, you type in September 15th, and what's going to happen is behind the scenes, the X-Trader is going to calculate the gross basis from September 15th to October 3rd in this case. Not from today to October 3rd, but from September 15th to October 3rd. That makes that target IRP true. Add that to the converted futures price. So you are trading a September 15th start for your 2-year contract as far as the cash equivalent. That opens up a whole new range of trades. You're not stuck either looking at October 3rd or today. You're looking at a whole new range of trades that you can trade. If you want to look at a forward starting thing, maybe you don't care about the September contract so much. You want to look out to December, you want to look out to March. Change your contracts, go out to the March 17th, have the March 5-year contract trading against a forward starting strip of euros. March 17th, and off you go. If you've ever tried to monkey with this math in the background, this makes it easy. So, recent developments impacting the TED spread. While you're all here, how do I make money with this? Interest on overnight reserves. It's kind of a geeky little thing, but it's a way that the Fed can try to put a floor into interest rates, overnight interest rates. It's one way of keeping the banks from lending free money basically to each other. To get more technical, I don't want to do that here, but basically it's going to help the Fed when they decide that they want to start sopping up excess reserves, raise that floor. And it's going to impact Fed funds, it's going to impact repo, and it's going to impact LIBOR. What it's unlikely to impact are short-dated treasuries. That is going to have some supportive type impact on TED spreads. It'll help them to keep from collapsing. The reverse repo facility, for the gray hairs in the room, we remember when repo was the tool of the Fed. Add reserves, take away reserve, match sales in those days instead of reverse repos they had. So match sales, reverse repo, same thing. That was the tool. So the fact that they're testing a program and they've tested that thing ad nauseum, and the fact that they're making a big deal out of it, tells us that we should be paying attention to it, even though it's an old mechanism. It's going to be one way without jacking rates specifically that they can start to sop up excess reserves. That too, in the same way as the interest on overnight reserves, that too will add a little bit of a floor or a little bit of support to TED spreads. Capital costs. They're all going up to the banks for private LIBOR-based assets. That's gonna be supportive of TEDs. Geopolitical risk, not the one that everybody, when I say that, they all think, oh, flight to quality and all that sort of stuff. Now, what happens if Russia gets stubborn, but doesn't shoot? There's a lot of exposure for US companies and European companies in Russia. That could actually be a major depressant to TED spreads. The Fed, as the ultimate nanny, may step in and decide to be the welfare queen for everybody. So that could be a major depressant for TED spreads. LIBOR structure, as Fred mentioned, when it was a managed rate, and it still is to a degree, but it looks like it's going to proceed more toward a market rate, that should add some volatility. I don't know which way it's going to go, up, down, but if it becomes a market rate rather than a managed rate, that should add volatility. And lastly, a couple of years back when I was here, labor market developments. Tassos made a big deal that the Fed wasn't going to do anything until the labor market changed. Now they seem to be moving the goalposts, at least on the surface, of what means a healthy labor market. We're down into the rates into the unemployment rates where they talked about. And now they're moving the goalposts on us. They're saying it's the quality of the jobs. It's part of it's there because of the uptick in the number of people that have left the labor force. That's worth watching. If they start changing their tune on why the unemployment is there, it's going to add volatility to TEDs. That's where they're going to go. If you think back to the chart that Fred had up earlier, we're really, really low across the board at levels, and we're back into, at least for the 5-year, kind of normal-ish volatility. So maybe there's trades where you trade, say, the lemon TED for the 2-year versus the engineered TED or the analytical TED for the 5-year. Maybe a bundle of the 4-year bundle versus the red pack plus 2s and 5s. The 3-year versus the reds. Anybody that's ever traded the 3-year knows it's a little psychotic. Maybe that's a fun little trade to trade. But you can now do all of that in one ladder.